On June 22nd, Michael Saylor bought 520 Bitcoin. And then he stopped. 5 weeks with no buys. The longest pause since this whole strategy began back in 2020. And 6 days after that final purchase, Bitcoin bottomed under 59K, while Strategy was selling 3,588 coins straight into the low. The biggest corporate buyer this market has ever seen walked away and even began to sell some coins. And then Bitcoin rallied anyway. For 2 years, the loudest argument against Bitcoin was that if you take away Saylor, the bid for Bitcoin disappears. And if he were to ever sell, well, Bitcoin would be over for good. Well, that argument just got tested by the market, and it failed. So today, we're looking at why Saylor stopped, what he's buying instead of Bitcoin, and why the relationship between Bitcoin and Strategy is changing. My name is Lewis, and this is the Coin Bureau. Now, to get a clear picture on the discussion today, we have to remember what Strategy actually represents in the Bitcoin market. For 6 years, this company had exactly one setting: issue paper and then buy Bitcoin. Convertible notes, common stock, 4 different flavors of preferred, all of it funneling into the number one crypto asset. The result is a balance sheet holding 843,000 Bitcoin at an aggregate cost of about $63 billion. That's an average price of around $75,000 a coin. And Bitcoin, at least as I record this, is sitting well below that in the 60Ks. So the largest corporate Bitcoin position on Earth is currently underwater by quite a bit. Now, that alone wouldn't stop Saylor. Being underwater has actually never stopped Saylor. What stopped him was the structure of Strategy's operation. On June 29th, Strategy filed an 8K announcing what it calls the Digital Credit Capital Framework. And when all is said and done, what that amounts to is a total reversal of company policy. 4 things came out of that filing. First is a formal USD reserve policy, a minimum cash floor equal to 12 months of preferred dividends and debt interest. Second, a Bitcoin monetization program, authorizing the company to sell coins, capped at $1.25 billion. Third, $2 billion of buyback authority, $1 billion for its own preferred securities and $1 billion for its own common stock. And fourth, a dividend hike on its STRC preferred, up to 12% a year. And so it became clear that Strategy had matured into a treasury department. CFO Andrew Kang put it in 3 words that would have been hearsay just 12 months ago. Bitcoin is capital. That means treating it as capital, something you deploy when the return on deploying it beats the return on holding it. But from there, the story of Strategy took another turn. Because the flywheel that Strategy became known for during the upside of Bitcoin's most recent bull market started spinning the other way. Between July 20th and July 26th, Strategy sold 5,429,160 of its own shares through its at-the-market program and raised $544 million, $500 million of fresh equity. And how much Bitcoin did Strategy buy with that money? Well, 0. And that wasn't the only raise. An earlier July window brought in another $466 million, also with no coins attached. So Strategy is still issuing paper. It's just that the paper now feeds the credit stack instead of the coin stack. And what did they do with it? Well, in that same window, July 20th to 26th, Strategy bought back 288,930 shares of its own STRC preferred for $25 million. Average price around $86.50, against a par value of $100. CEO Fang Li asserted that below $100 a share, repurchases reduce future dividend obligations at a discount, which is, in fairness, good capital allocation on the face of it. But it's just that it's the exact opposite of everything this company has ever told you about the value of holding Bitcoin over holding dollars. And there's $975 million of that authorization still unused. Meanwhile, there's the cash pile. On June 28th, Strategy held $2.55 billion in USD. By late July, that number was $3.75 billion. an all-time high, $3.75 billion in dollars, sitting in the treasury of a company whose public identity is that dollars are essentially melting ice cubes in this fiat currency world of ours. That $3.75 billion is roughly 2.1 years of coverage on its preferred dividends and debt interest. So the accumulation flywheel turned into more of a deleveraging flywheel. Now, if you remove the largest, most price-insensitive buyer from any market, the price should fall, right? But that's not what we saw with Strategy and Bitcoin. So let's just walk through it to see exactly how the market reacted to Strategy shift. June 22nd, that was the last purchase. June 27th to the 28th, the market bottoms, with Bitcoin printing a year-to-date low close to $58K and closing June 30th at $58,500. June 29th to July 5th, Strategy net sells 3,588 coins for about $216 million. The largest holder in the world is a net seller at the lows into the worst ETF month in the product's history. And yet, by July 21st, Bitcoin had rallied back to around $66,000. That's nearly a 14% move off the bottom, with the biggest buyer absent and briefly on the wrong side of the book. So then, what took the other side? Well, we could start with the ETFs, although that market did look ugly for a bit. Starting with that ugliness, US spot Bitcoin ETFs bled somewhere close to $4.5 billion in June. That smashed the previous record of $3.56 billion from February 2025. BlackRock's IBIT alone accounted for roughly $3 billion of it. And just quickly, it's worth understanding how these products actually work in this context. When shares get redeemed, authorized participants have to sell actual spot Bitcoin to settle it. It's programmatic selling that doesn't care what you think about the halving. Some analysts have estimated that every $1 billion pulled out of these products dragged the spot price down by several percent. So these outflows were outright bearish. But after those outflows had run their course, things turned. A 10-day, $2.73 billion redemption run snapped back on July 2nd. And between July 14th and July 23rd, the complex pulled in about $981 million across 7 sessions, IBIT taking roughly 71% of it. So the ETF bid finally showed up, and it was met with other eager market buyers. On July 2nd, the same week Strategy was selling, Japan's Metaplanets bought 2,823 Bitcoin for $170 million, taking its stack to around 43,000 coins. One treasury company selling into the low, while another buys that same exact week. And the on-chain data tells a similar story. Glassnode figures reported by CoinDesk showed long-term holders flipping from net distribution to net accumulation in early July, with smaller and mid-sized wallets doing the buying. Bitwise CIO Matt Hogan argued those holders provided the liquidity that absorbed the ETF redemptions. CryptoQuant's Ki-Young Ju described it as a handoff, old whales selling, ETFs and treasuries catching. And Hogan's verdict on Strategy itself was interesting. Their run as the most dominant buyers of Bitcoin, in his words, is likely finished. He thinks institutions broadly fill that gap. So the marginal buyer went from one man with a convertible bond desk to something distributed and considerably harder to short.
What if you could trade real US stocks like Apple, Nvidia, or Tesla without leaving your crypto account? Well, that's the idea behind R tokens from BitGet. These are tokenized stocks backed one-to-one by real shares, but the key difference is they are actually usable. You can trade them, use them as margin, and even earn dividends instead of just letting them sit in your wallet. So, if you want to check them out for yourself, sign up for BitGet using the link in the description or by scanning this QR code.
Now, before we all get carried away, there is something else that deserves mentioning. The real bear case here comes from everyone who copied Saylor. July saw a wave of smaller digital asset treasury companies liquidating. Satsuma Technology voted to sell its entire 668 Bitcoin position and delist from the London Stock Exchange. Prenetics dumped its full 510 coins. Genius Group liquidated its whole treasury to repay $8.5 million of debt. Emperor Digital sold 1,400 coins to repay debt, cover legal costs, and partly fund a stake in an AI data center project. So, every company on that list sold to meet a payment that was coming due. Meanwhile, Nansen's analysts have been warning that July's recovery looks more like a positioning bounce than a regime change, with Bitcoin capable of retesting the mid-50Ks if ETF demand doesn't stick. Bitfinex flagged 68K as the make-or-break level going into August, since that's roughly the average entry of the last 5 months of buyers. So, Bitcoin is not out of the woods yet. But here's what's changed. The forced seller thesis on Strategy used to be unfalsifiable. You had roughly 4% of all Bitcoin that will ever exist, sitting inside a leveraged entity with a preferred dividend stack and no disclosed limit on what it might have to sell. That risk was completely unquantifiable, which left the market free to assume the worst. But that June 29th filing put a number on it: $1.25 billion. Roughly 20,800 coins, or about 2.5% of the holdings. That is a broad authorized, published maximum, and they've used about 17% of it so far. Before this framework was decided upon, Strategy was carrying around 10 months of cushion against its dividend and interest obligations. Today, with a $3.75 billion reserve against roughly $1.76 billion of annual obligations, it's carrying somewhere between 24 and 28 months. The bear case relied a lot on Strategy's ability to cover dividend payments, but the firm's coverage has more than doubled. They helped address concerns about key man risk by issuing paper and shoring up a beefy buffer of cash. And there's one detail in that policy worth noting. The USD Reserve is not allowed to fund the preferred buybacks. Those have to come from equity issuances or Bitcoin sales. So, the cash meant to pay dividends is ring-fenced from the cash used to opportunistically retire dividends. Which brings us to the all-important number in this dynamic, and that, of course, is MNAV. MNAV is simply the multiple of the underlying Bitcoin that the market is willing to pay for the company. Above 1, issuing shares to buy coins creates value for existing holders. Below 1, it destroys it. On June 27th, Strategy's enterprise MNAV fell below 1 for the first time in its history. And so, the market was saying that the Strategy operation no longer works. Depending on whose calculation you looked at, MNAV fell as low as 0.72. But as I make this video, that multiple sits at roughly 1.03. So, the company stopped buying Bitcoin, sold some Bitcoin, raised equity it refused to spend on Bitcoin, and the market re-rated it upwards. Benchmark's Mark Palmer is still carrying a $570 target on the stock, calling the reserve build disciplined capital allocation. Elsewhere, Peter Schiff, predictably, thinks the common stock goes to zero, pointing to Bitcoin yield per share collapsing from 13.3% in May to 4.5% by late July. Now, you might reasonably be thinking that none of this matters to you unless you own MSTR. But it does impact you if you own any Bitcoin. Because every time the Strategy complex takes a hit in the market, your Bitcoin is likely to sell off. You were, in essence, short one company's dividend calendar. But that's the thing that just got smaller. Bounded and funded 2 years deep. So, who actually profited from all of the fear around Strategy? Well, the people who sold you the story that Bitcoin was a one-man leveraged trade and shorted the equity into a 40% 3-month drawdown. This whole thing was a capital structure problem, but people were trying to insist that it was a Bitcoin problem. For 2 years, the bear case centered entirely around Strategy and Saylor's musings, rather than Bitcoin itself. July was a big test for that thesis. The buyers stopped, sold 3,588 coins into the low, raised $1 billion of equity and spent none of it on Bitcoin, and the price went up anyway, carried by ETF flows and a few 100,000 long-term holders. Bitcoin's original case as a digital asset never had anything to do with corporate treasuries, and you could easily argue that it just spent a month proving that once more in the public markets. But what do you think? Is this a decoupling that holds even if strategy stays on the sidelines for the rest of the year? Or is July just a positioning bounce that unwinds the second the next dividend calendar comes due? Let me know in the comments down below. And if you're more concerned about the fate of altcoins than you are about the fate of Bitcoin and strategy, well, then you should definitely check out our video on where altcoins stand in 2026 right over here. Thank you all so much for watching, and I'll see you again very soon. This is Lewis, signing off.